Welcome back. Rajesh Kothari is now with us, Managing Director at AlfAccurate Advisors. Rajesh, good to have you with us here. Thanks very much for your time. I think last interacted on the editors roundtable on that Friday, and the mood was so different, right? It was, and how the mood's turned, and for the positive, for the better, and that is what markets are all about. But what have you been doing, Rajesh? We spoke about a few ideas, few opportunities back then. Give us a sense of what you've been up to with the fund. Any names you've added, anything you've added on, or in terms of what you already owned.
Yeah, well, I still remember that Friday roundtable discussion, and if you remember on that day also, we explained that during COVID also, in first 7 days, market discounted the worst effect. In Russia-Ukraine war also, in first 90 days, market discounted the worst effect. And I said this time is not going to be different. Donald Trump 75 days were over that time when we did the roundtable. So I think now Mr. Trump is a kind of a discounted story. In fact, there are many guys, they are terming him as a, reversal godfather. He's a godfather of doing reversal things. So I think that is now behind us as from market perspective. Effect on economy, nobody knows. It may continue for 2, 3, 4 years. I think the domestic-driven economy, domestic-driven sectors, that will do much better compared to the globally linked businesses, like what we discussed last time. So those are the sectors, on which we have been increasing our weightage. The banking is one sector, which is our largest holding right now, on which we are positive. The second is the pharmaceutical, more domestic linked businesses, the CDMO space. That's very interesting. So that's the second sector where we are increasing the weightage. Third is the consumer discretionary. And I think the discretionary sector in general has been doing reasonably well. And I think there is a solid earnings growth coming on the few pockets of consumer discretionary. So that's the third pocket. And the fourth is, select, capital goods companies which are really focusing on HVDC kind of a micro segment, the metro trains, Scott transformer related segment. So this is basically the few pockets on which, we have been increasing our weightage in last, I would say 2, 3, 4 months.
Mm. Okay, banks, CDMO, consumer discretionary, and power and areas like HVDC, Hitachi, etc. we've spoken about in the past. We'll just come back to you, Rajesh. Numbers are trickling in. IOC was the last. Sudarshan is here with quickly explaining the numbers to us. So over to you.
So we were expecting, basically our estimates were suggesting that IOC may report a mixed set of earnings, but after BPCL, which had reported a strong set of earnings led by refining, similar picture is being seen with IOC as well. Refining continues to be strong for these OMCs. And here also, if you take a look at gross refining margin, the estimate was that gross refining margin may come in the range of $4.5 to around $6 per barrel, but company has beaten the estimates, and gross refining margin has come in at almost $9 per barrel, much higher than the expectation. Even on the revenue, EBITDA and margin front, revenue has also come in higher than estimate. It was at 1.95 lakh crore versus our estimate of 1.91. EBITDA has come in at nearly 14,000 crore against the overall estimate of nearly 8,000 crore, and margin has come in at 7% against estimate of 4.10%. Also, if you take a look at both the throughput, refining as well as the pipelines, at both the places you will see an improvement not only on a sequential basis but also year on year. So overall, it's a very strong set of numbers from two oil marketing companies that have reported earnings so far. Both BPS and IOC have reported a strong set of earnings. So we'll be taking a look at when HPC announces the numbers, and if it announces a similar set of numbers as these two companies have announced.
Thank you very much for that. And Sudarshan, in terms of the LPG under recovery, who is most exposed? So when that under recovery comes, who is likely to see the biggest benefit?
So amongst all, 50% of the total compensation LPG has an exposure to. So whenever the government decides to compensate for that, IOC would be the biggest beneficiary.
Okay, thank you very much for that. Rajesh, you've not mentioned oil marketing companies in the preferred sectors, but tactically, is there any opportunity? IOC, BPCL, and plus there is the trigger awaited of the LPG under recovery.
I think, these are the businesses on which generally we do not take exposure because it's very extremely difficult to predict the crude oil price, the refining margin, and the government policy in terms of how much to recover and how much not to recover. So I think all these are more policy-led businesses rather than pure economics. So generally speaking, we avoid investing in refineries and marketing kind of companies.
Okay, all right. Rajesh got that point. Markets actually seeing a little bit of green right now, about 50 points up on the Nifty at this juncture. So, Rajesh, what else? I mean, where else are you looking for opportunities where at least there is some decent earnings visibility? Because lots of sectors like consumer, etc., they're still going through a rough earnings patch. So, what is on your radar?
So I think there are few sectors where you are clearly seeing the very strong earnings growth. Look at, for example, the consumer discretionary space, and two retail companies have already announced their numbers, and both have reported a 25% plus revenue growth. And one of the companies, of course, the largest company, even on a high base, they reported 25-30% growth. So I think it is a solid number reported by the largest company, and of course, even second retail companies reported 20% plus growth. So consumer discretionary, few pockets within that is doing extremely well. That's first. Second, look at the affordable housing segment. Again, three banks and also the two large NBFCs which are into affordable housing segment has reported strong numbers. So I think the housing segment is going to do extremely well. And third, where of course the numbers are not yet announced, but we are expecting a positive growth momentum to continue, is the healthcare and hospital segment. And I think even this segment will report good double-digit growth. Please remember the Nifty this year, FY25, Nifty earnings growth is going to be only 4-5%. It means the economy is actually a little bit struggling. And against that 4-5%, these are the housing finance companies or the retail companies, apparel side particularly, they are growing and reporting 20-25% growth. One of the company which is into the soft drink, the reported numbers today, has again reported very strong numbers. There was a market narrative that one other player has entered and therefore there is going to be tough competition, the price war will start and all that stuff. But look at the company's numbers. The narratives are different and the actual delivery is completely different. So if these companies are growing at 25% plus in an environment where a consumer is kind of slowing down as per the narrative, I think it is a fantastic show by a few companies. So, bottom-up strategy is going to work over the next 12, 15, 18 months. And these are opportunities where we are looking to add.
Rajesh, take that point, but specifically on retail, this large company that you spoke of, I know you won't get into individual names and stocks, but I mean, let's say if you're talking about a stock like Trend, and yes, the company is still showcasing 25-30% sort of growth, but the argument now is on valuation. Does this market have the mood and the appetite to still keep buying stocks at 70-80 times? Because the earnings growth rates are no longer 50-60%, but they're 30%. 30 is not bad. But then again, at what price?
Very good question. And let me give you some data. The Nifty is reporting 4% earnings growth. The Nifty is trading at 19 times price to earning multiple. It's 5 times PEG. Let's talk about Nifty normalized earnings growth of 11% next year. And Nifty is trading at around 20 times. It's 2 times PEG for 11% growth. Look at S&P 500. It's trading at 1.8 times PEG. So in a growth phase, you have to look at PEG because we are not buying 2% growth companies. Am I right? And look at any other company. For example, the India's largest IT company, what is going to be earnings growth? 7%? And what is the price to earning multiple? 22 times? 3 times PEG? Now, Trend, for example, what you talked about, please put a disclaimer, is growing at 25-30%. And if you look at the FY26 and FY27 valuations, they are below probably the Nifty PEG. So that's where you make money because on a growth companies, you need to look at PEG with, of course, ROE and underlying balance sheet. And that's where all these companies, and they've been the biggest winners for last 3 years, 5 years, 10 years. Small correction, of course, will be there. Some disappointment in between SSG growth and micro analyzing of each number and penalizing company, fine. But after 1 year, where you will grow? You have two options. Either you invest into India's largest FMCG company, which is struggling for 5% revenue growth and 10% profit growth, and you buy at a PE of 50 times and feel happy. Or you buy a company which is growing at 30% at a PEG of probably less than 2.5 times. I think you make probably more money over there. Of course, if they continue to report growth, if that assumption goes wrong, then even if you lose money, even in that case.
That's an interesting argument, a solid one at that. If a company like Trent says growing at 3 times PEG, price to earnings growth, which is still lower than the Nifty PEG, so then maybe you're not that bad off. It's an interesting lens and one that investors must perhaps keep in mind. Nigel?
Well, Rajesh, just one question from my end. In the past, I recall you all have played this travel and hotel theme. The travel stocks, they could pull back a little bit. If I look at Interglobe Aviation, that's pulled back a little bit from the recent peak. There's going to be a bit of a skirmish on the border. So some of these hotel stocks a little bit nervous. The luggage makers are a little bit nervous as well. Would you use this as a buying opportunity?
So probably there is still going to be some wait period over there, particularly in the luggage industry side, because the price war between the top three players is still ongoing. And, on the other side, some consumption slowdown. So the macro is not going to be that strong. And in between, the two players are a little bit trying to do price war. The inventories are still very high in the system. So we need to wait for the right time as far as luggage industry goes. As far as hotel industry goes, we do not have any exposure to, the hotel industry. And probably, I think the best of the realization is probably behind you. The best of the peak capacity utilization, because now many other hotels are also expanding, right? So one need to do a little bit more demand supply analysis before taking the final view. Currently, we do not have any exposure to either of these sectors.
Got that. By the way, in the CDMO space, Rajesh, what's the pick? We have a few listed players.
Yeah, so please put a disclaimer. So we are holding Suven for quite some time. And we believe, I think the overall opportunity is very strong. The opportunity is very big. And there are only few players who basically has a 30% plus kind of a margin profile in this kind of a businesses. And, forget China plus one, even the orders which are otherwise what Indian companies are getting, and because of the acquisitions, the new capabilities what these companies are winning into, I think you have a very, very long, roadmap over the next 3, 4, 5 years. So the growth is going to be compounding. And as you grow, the opportunity to participate into the larger size molecule, that comes basically handy. So, from, $10 million to $20 million to $100 million. So as you enter into different niche segment, the opportunity becomes really very big.
You're talking about Suven Pharma, right, Rajesh?
Yeah,
Suven
you're
Pharma.
right. Yes.
Okay. All right. Got that. Thank you very much, Rajesh. Appreciate you joining in. And of course, full disclaimer, as Rajesh himself pointed out, he'd own the name in their fund. So please do your diligence before you decide to take action if you do. Well, we'll take a quick commercial break here. Markets, of course, are up sharply as we go into the close. It is the last 30 minutes or so. And it's come up from about 240